Hey, good morning, everyone, and welcome to the Macro Snapshot. We are Friday, March the 6th, 2026. My apologies, there was no video yesterday morning, but I was feeling a bit under the weather, still feeling a little bit sick, but that's okay, getting better. Okay, let's have a look what's going on. Obviously, we have non-farm payrolls today. Unusual for a Friday, we also have retail sales. And of course, obviously, with oil, that's the big thing which is driving markets and the Iranian situation. So, first of all, just very, very quickly, let's keep an eye on volatility here. You can see that the VIX is trading up to about 25. So, I mean, obviously, it's choppy, but this is a very elevated level. So, a lot of intraday sort of swings happening, and that's an implied move there at well over about sort of 1.5%, which can also be to the upside, of course. So, apart from in the equity space, we also see that the bond volatility is still pretty elevated as well, and obviously in oil, OVX is going through the roof. So a lot of volatility everywhere. And as I keep on trying to say, mechanically that means that sort of vol targeting funds, any kind of institutional trading desk will automatically reduce their VaR, their sort of value at risk until things calm down a little bit. So let's expect a choppy action. So let's just quickly have a look at the oil market. I mean, kaboom, a huge green candle overnight, which is a bit upsetting to me because I did have the on the USOs, I had the 92 to 97 call spreads, which actually exited yesterday. So I thought that was nice, but looking at it this morning, USO is up to 102. Anywho, you can't complain about that. But oil now getting up to a level which is causing serious inflation concerns. So this is WTI, similar situation, of course, if we look at Brent here. And as we get into I think it's day 6 or 7 of the conflict, I was just reading some research from JP Morgan, essentially saying that as we go further and further on, there's going to be like 3 million barrels of oil per day of production shut in and sort of closed down, and then maybe 4 million barrels of oil per day, then 5 million barrels of oil per day. Of course, the point is that if no tankers are leaving the Strait of Hormuz, then at a certain point, all the storage sort of on land starts to fill up. And countries like Iraq, we've seen, have already closed down quite a lot of their production. And we've also seen Qatar for the LNG has also closed a lot of their production. So the point is that less nat gas, less LNG, less crude oil. We've already seen jet fuel. I think in Europe, I saw somewhere jet fuel has doubled in price. So all of this stuff is very, very inflationary, and obviously is causing oil prices to go up. Yesterday, the Trump administration, they released a sort of a headline saying, oh, maybe the Treasury Department could start using futures. I guess that I took that to mean that they would start selling the futures to kind of calm down oil. That had a little bit of a calming effect for an hour or so, but they've come out this morning and said, oh, actually, they don't think they can fight the market. So that's sort of a waste of time. There's been some talk globally about the various countries releasing their parts of their strategic petroleum reserves. Japan may be thinking about doing that. We shall see. But the point here is that effectively the Strait of Hormuz, even despite Trump saying that there could be convoys and insurance, the reality is that there's almost zero traffic, shipping traffic going through there, which means, of course, oil exports. Now, the Saudis have transferred some of their sort of oil production, sort of exports to the Red Sea. They have kind of like a pipeline going across Saudi Arabia, but it's not nearly going to be enough. So the point is that every day the pressure cranks up, and we're slowly, oil is I'm not going to say running out because that's not the case, but it's definitely becoming more of a premium. And we saw this morning, actually it was overnight, that the US, with breathtaking cynicism, have given Russia a 30-day waiver on the sanctions to sell oil to India. So Putin, no doubt, is having a wry smile in the Kremlin at this point. So anyway, basically, there's going to be some more Russian oil being released sort of legally to go to India. There's also talk to the Chinese negotiations with the Iranians in order for the Iranians to allow safe passage of any tankers with a Chinese destination. So a lot of work going on behind the scenes, but you can see here the oil market here starting to really, really take off. And let's just put a bit of context here, maybe throw on maybe a weekly chart might be the best one, even a monthly. But you can see here on the weekly chart, we really would have to go back to the Russian invasion of Ukraine in the spring of 2022 here, summer of 2022, where you see we got almost up to $100 on the WTI. So you can see here that we've taken out this, October 23 price of about $80, and we're now pushing higher. So you've got to say that every single day that there's no more resolution. And my personal view, who cares? But my personal view is that the Iranians are obliged to fight, or what do they just stop now and I don't know, change government and change the regime? And the Americans, what are they going to do? They say, oh, we assassinated a bunch of leaders, but nothing really has changed. So we're at a bit of a Mexican standoff at this point, and I personally believe that perhaps there's been some degradation of the Iranians' ability to fire missiles. There's talk that their ballistic missile capacity is sort of dwindling, and for sure they're firing less missiles every day. But the reality is now you have Azerbaijan involved, you have Qatar involved, you have UAE involved, you have Saudi Arabia trying to stay uninvolved. There's talks about Poland, Section 5. There's a lot of stuff going on. So the point is that it's not easy for anyone to de-escalate at this point, especially the Iranians and the Americans. So I do believe that we could just continue to see oil sort of squeezing even higher, over the next few days, unless there's some, dramatic about turn. We're also seeing the spreads are going pretty crazy. You see here April to June, which is a 3-month spread, now up to $7, very, very high. And then what's pretty crazy is April to December 26, Z26. You see that's just ripping. I mean, that is absolutely nuts. Up to $18 almost. So what's going to be interesting about all these trades is just to notice what's going on. And if indeed, hopefully, we get some kind of resolution, there are going to be sort of massive, massive opportunity, massive reversals in the oil trades. And I'd recommend something like sort of December futures, shorting that spread is going to be a very interesting trade when and if we get some kind of compromise resolution, armistice or whatnot. Let's have keep an eye on that. Okay, so why do we care about energy? Obviously, the issue here is the potential for inflation and the Fed potentially hiking and other central banks hiking and whatnot. Now, let's just look at some of the yields here, give you a sense of what's going on. Here's the 2-year yield in the US. You can see that this was trading at about, let's call it about 3.4, now up to about 3.62. So that's gone up almost about 25 basis points. That's a full cut, has been repriced hawkishly. Similar kind of situation. You look at the 5, you look at the 10-year yield, and you look at the 30-year yields. All of these have gone up 15, 20, 25 basis points. And if we just look at the short-term interest rate market, you can see here, just for example, I'm going to look at December 26. That's gone up almost 35 basis points in terms of the yield. So the market really extrapolating from these higher energy prices that central banks will not be able to sort of cut as aggressively, may even be forced to hike at some point. Bottom line is that they've repriced very, very aggressively in a hawkish way. You can also see it's not only in the US with the Fed. It's also, if we look at the Euribors, which is similar to the SOFRs over in Europe, the 3-month sort of contracts here, you can see that the Euribor for December 26, which is trading, approximately around 2%. Remember all that talk, the ECB saying we're in a happy place, we're in a good place, we don't need to cut, we don't need to hike. But you look at that the bond market has said otherwise, and that's gone up about 35 basis points or so. So point being here is that the market has very hawkishly repriced in terms of the yields. Now the yields, these very, very high yields, this has had all kinds of sort of correlations. And really what's important as well, also if we get unwinds, is just to see the correlations here, is that we're seeing with these high yields and maybe a little bit of a safe haven bid, but really the high yields are giving a big, big push higher here for the dollar. This is the dollar index, which is pushing much higher. And you can see, who knows if we're going to push up to the 100 level. You see the euro obviously under a lot of pressure here, down at about 115.5. Japan, the Japanese yen under a lot of pressure. You see the US dollar. And again, a lot of the countries which are really being negatively effective are the big energy importers, which overall is like the European space. It's countries in East Asia like China, like Japan. Japan imports, I think, 95% of their energy, and Korea. So you're seeing the Korean won under pressure, the Japanese yen, and let's have a look at the renminbi as well. You see the renminbi, which had been super, super strong, that's also under a little bit of pressure. So the point is here is that US dollar doing very, very well with these higher yields. In terms of the yields, we're also seeing a huge sort of flattening of the curves. If we just look at a few of the curves here, if you look at the 2s, 10s, you can see that that's flattened aggressively. If you look at the 2s, 30s, you can see that's flattened aggressively. So basically what's happening is that all yields are going up, but especially at the front end, it's really sort of ripping to the upside. So that's a sort of a flattening the curve here. Okay, now in terms of the cross correlations here, what we're seeing is that something like gold, which one would imagine in this sort of geopolitical risk, I mean, it did initially rip higher on the Sunday night when the Americans unleashed their attack. But you can see that subsequent to that, gold is not enjoying these extremely elevated yields and the very, very strong US dollar, which is the traditional relationship that normally as the real yield um, sort of goes higher, this becomes less attractive to hold gold, which of course is a non-interest bearing or non-yielding sort of instrument, although that relationship has decoupled a lot over the last couple of years. But the point is here, the gold is under pressure. And part of the pressure is that, for example, if you look yesterday, there was a huge downdraft of about 1,500 ticks yesterday morning, about 8 o'clock. There was a headlines that the National Bank of Poland, which is actually a fairly major holder of gold, was considering selling off some of their gold reserves in order to fund spending for defense. So the gold market didn't like that, and it could be that one of the reasons, also the point I'm trying to make, is for gold a weakness apart from the high yields and the very strong US dollar. Is the fact that various entities, maybe not only central banks, but sort of companies, trading firms, hedge funds, gold is very liquid, and maybe just to as they sort of deleverage some of the other assets, you can sell off some of the gold just to raise a little bit of cash and a little bit of liquidity. And so gold, under pressure there as well. And keep in mind that we did see that in the first few days of the COVID crisis, as I think I mentioned a couple of days ago. The gold, obviously it's a safe haven in a certain sense, but when you need liquidity, gold is your friend. Similar situation here for silver, not doing too well. What has got my attention just quickly while we're here is looking at the Bitcoin chart. Grab some tea. I signaled in the last video a couple of days ago that this sort of 38% fib would be the first real test for the bulls. So we did have this sort of a basing formation here where we're getting sort of higher lows and whatnot, and that's fairly promising. But what we can see here is that if you look at this downdraft, or even look at this particular impulse, let's say going from the 15th of January here, you can see that we had the overhead resistance coming in at about 74,500, which also is the fib, the 38% fib retracement. And basically what I was trying to point out is that this is the first test for the bulls. They needed to clear that convincingly to say, hey, we're going to bull this, but we haven't had that yet. And so far, at the first substantial test, the BTC bulls have failed. Let's just be very clear about that. But if we put it onto a 4-hour chart, maybe just to have a little more detail here. Not all is lost, because what I would say here, what would be very negative would actually be the following. So if we now, I mean, that's okay. So it was rejected at the 50%, but I would say what we really need to do now is to look at what happens sort of today. So you can see here that we've retraced, just going back to, let's say, the 27th of February, you can see that we've retraced now to the 38% fib, which is a pretty key level here, around about 70,000. Really what needs to happen now, this is where the bulls need to buy this dip, because if they cannot buy this dip and we drift down through the 38%, the 50%, and the 61.8% fib retracement, and we get down to, below, let's say, 66,000, that would be very, very negative price action, and it's not good. And that, in my humble opinion, could leave the way open for further downside. So I'll be looking at this today. But if the bulls come in here, something like this 38% fib retracement, this 50% fib retracement, anything from around about 70,000 to 60, let's call it about 69,000, come in here and pull it, and then push it back up, then you could say, okay, not bad. They've done what they needed to do. But a failure to do that, if it goes down through these fib zones, as I say, down through these green zones here, would be very, very negative. Okay, let's look at a couple of other things as well. Looking at the equities, equities remain weak. I mean, overnight, you can see that they're down. ES futures down about 60 basis points since the session opened last night. NASDAQ 73 basis points. Russell down 75 basis points. Equities trading weak. They are not liking these elevated yields. Oil prices ripping higher. There was also some, nasty headlines yesterday, sort of some talk going around that the US government actually wanted to extend the sort of, I'm not going to say export bans, but basically make it necessary for companies like chip makers like NVIDIA and AMD, when they're exporting their most sort of sophisticated chips in large quantities, maybe in sort of batches of more than 1,000, that they essentially would require a government review and some kind of sort of export license. And we saw yesterday a big downdraft in for people who were trading yesterday. We can see here that the when that headline passed, Nasdaq was sold off hard, Nvidia was sold off hard. It was subsequently reversed at the end of the day because there was some positive sort of news on oil. But the point is that the equity markets are trading very, very heavy here, and you can see there's a bit of rotation. Like you see the SMH, the semiconductor index, still trading, on the heavy side, as I say. What is interesting is that the software ETF IGV did, as I was signaling a week ago, so did have that nice bounce off that pretty key level. So maybe it's just rotation at the moment, but the equity market definitely is sort of soft. And if we look at global equity, we can also see what is interesting here is that a lot of the sort of the popular trades like rest of the world, emerging markets, whatnot, they've been a bit battered. And we can see here just the relationship of SPY versus sort of Europe and the sort of Asia developed markets here. You can see that there's a relationship of sort of US underperformance has actually been substantially reversed just in the short term while we've got this drama going on. So the US, a bit of money flow going into the US on a comparative basis, not an absolute basis, on a comparative basis. And you can see here that the Euro Stock 600, big red candles really being battered down. You see the Germany, the DAX being absolutely whacked, obviously close proximity, and the energy prices over in Europe. If we look at the nat gas contract, doing very badly, but it's not over in Europe. You can see here that the Nikkei up today a little bit, but also under a little bit of pressure. We can see Brazil, trading heavily. That was doing pretty well, but it looks as though even the strong sort of oil prices, actually just the flows are going out. India, which imports all of its oil, also under pressure. You see the Sensex here down a lot. You can see China also. Look at, let's say, Hang Seng Enterprise, also up a little bit today, but essentially trading heavily. We see the Kospi up a little bit, but has been trading on the heavy side. And we can also see the EEM, emerging markets, also down. So the point is that, there's going to be a few bounces here and there, but I think, a lot of those sort of very popular trades like, emerging markets, sort of East Asia, Europe, all of that stuff, will probably need to see some reversal and de-escalation in Iran to sort of to come back. And especially over in Europe, a lot of that is just due to the energy prices. If we look at nat gas here, you can see here that nat gas, we've been looking at this, the TTF, which is the benchmark, just ripping higher again. So this is not great for Europe. Now, of course, the other big news we have this morning will be naturally, we have the non-farm payrolls, which basically this is going to be seen through the optics of inflation. So what's expected is the headline number is expected about 59,000. We need to keep an eye out for the unemployment rate that's expected to come in at 4.3. And average hourly earnings, I think everyone wants to look at that as well. Average hourly earnings month over month, that's going to be essential at 0.3. Any sign that the labor market continues to be strong, we had, again, yesterday, initial jobless claims were strong. Any sign that the labor market is doing well, and especially average hourly earnings are going up. Yesterday, we had the employment cost index from memory was a little high as well. And we had some sticky inflation numbers, bits and pieces earlier on in the week. Excuse me. It's not a good, nice sounding cough. That's going to put even more pressure on this inflation theme. So keep in mind what the market is really looking at today is like, okay, inflation, oil prices ripping higher. Now, if the employment market, we see that non-farm payrolls is very strong this morning, and we also see the average hourly earnings strong. That's going to throw more fuel on the fire. This whole thing of like, oh my God, the Fed has to it can't cut as much and whatnot. We also get a bit of more information on retail sales. The ones to be looking out for, apart from the headline number, of course, which is expected to actually contract to 0.3. Really what you want to be looking out for is the control group, which is like the super core, which is expected to come in at +2, and then excluding autos, and then excluding automobiles and gasoline down to 0. So let's put those all together. But if the US economy, in terms of the employment market, the labor market, and retail sales, if they come in strong this morning, especially with the average hourly earnings, unemployment rate down, let's say a headline number at 70, 80, 90,000, that's just going to really sort of cause the the long term, the bonds are going to sell off, the US dollar rip higher. Gold may actually sell off as well as those yields go high. And equities, I think we're getting to a point where Equities were like Goldilocks. Equities would probably like to see, a number which is okay, maybe 50,000, maybe an unemployment rate which is sort of stable, and maybe average hourly earnings going down. Equities don't want to see a too strong sort of employment sort of scenario, because that would indicate that the employment, the economy is maybe overheating, which is not great news for the inflation story or for the Fed. And just finally, to close up, let's just look at what's sort of priced in here. At the Fed Watch tool, and you can see here that by the end of the year, I'm just going to take for December, you can see that essentially the market is pricing in at this point almost about a 60% probability in terms of the distribution weighting, about a 60% probability for just one cut, and about just over 40% for two cuts. So that's shifted a little bit. And if we actually look, I think if we look, let's look at the February just to see how the pricing is shifted. So if you look at the current, it's kind of the dark blue, and you can see that basically you can see that that's 1 day or 1 week or 1 month. You can just see here for zero cuts for compared to a month ago, that's actually gone up quite a lot. And then if you can see that overall, shifting from two cuts to one cut, from two cuts, that's actually gone down the probability, and just having one cut has actually gone up a little bit over the last week or so. So definitely the market just shifting, how can we say, to the right, a little bit more hawkish. And again, the non-farm payrolls number this morning, you have to trade that really through the optic, through the lens of inflation, and not so much just, oh, is the economy doing well? We know the economy is doing relatively well. Okay, guys, I'm going to leave it there because I think I need to blow my nose. Have a great trading day. I'll be back probably over the weekend with some kind of more sort of expanded sort of weekly market preview. But that's it for this morning, for the macro snapshot from the macro shop. Thanks very much. Have a great day and have a great weekend. Thank you.